Hi, my name is Arun, and today I'm going to talk about call options. How do you write and buy calls, and how you do it with Degiro online? Please note, options can be risky, so please consult before investing. Okay, talking about call options. So, what is a call option? Yes, call options are contracts that can give the option buyer the right, but not the obligation to buy a underlying at a specified price. We call it strike price, and with the specified time, as we call it, expiration date. Yeah, a call buyer profits if the underlying or the share price increase, as it can be seen here. Yes, if this is your strike price at which you have bought a call option, and this is the premium, just a sec, and this is the premium paid, then if the price of the share goes beyond your break-even point, then you start to make profit. In theory, you can make unlimited profit. Yes, and with the share price going up, you gain maximum as it goes higher. The wanted position for such a strategy is that the share price increase. So it's like a bullish strategy, and you want the share price to go higher. When it comes to writing calls, you're giving someone else the right to buy stock or underlying from you, but he or she does not have the obligation. By writing call, you are actually collecting a premium, and then you're hoping that the option expires worthless. And the wanted position is that the stock price or the share price stays below the strike price. Yes, that's when you make the maximum profit, which is the premium which you have collected in the start. Of course, there is a risk if you are doing naked calls, that if the share price suddenly goes higher, then there is a potential of unlimited risk there. Of course, uh, e- even if there is breach of the strike price, then at least you will still make some money till the time you reach your break-even point. Yes, after that you start to lose money. Talking about covered calls, in case you are writing calls without owning the underlying, then it's called naked calls. And of course, as we have seen, the max loss can be unlimited in theory, or also in market events like the recent Wall Street bets, which we have seen for GME, AMC. So, in case the stock price suddenly starts increasing, then you tend to make huge losses. So, how do we manage our risk? And that's what is called a covered call. So, basically, what you are doing is you're writing calls against the underlying which you are already owning. So, basically, what you're doing is you're writing calls against the shares which you are owning. And if you're writing a option contract, which is like one option contract, then ideally you should be owning 100 shares in your account. Idea is to make money by writing calls and let the options expire worthless. Yes, and the money which you are gaining is the premium which you are collecting till the time the strike price is not breached. Yes, so in case the share price suddenly goes higher, then your existing shares which you have in your account are used as a security and protect you from the unlimited losses which can happen. This strategy generally generates additional income, and if the underlying stock is not rising sharply. Yes. So in the example, I'm using a Deutsche Bank. I'm using online account Degiro. Yes. Just before I go show how you buy and sell call options, let's look at my approach, how I'm getting into the trade. So if you see here, I'm showing certain things. If you look here, this is a 3-year chart. Yes. And at least what I'm looking in this chart is if the underlying Deutsche Bank in this case has breached 10 euro price model in last 3 years case. If you see here, it has touched 10 euros occasionally. Yes. And then in the next slide, I have drilled into a yearly basis. So last slide was like 3-year time frame. So this is like a 1-year time frame, 2019 December to 2020 December. So what you see here is it is only once that it has breached the 10 euro time frame. Yes. And the reason why I'm looking for a 10 euro time frame is because I'm planning to sell a call or write a call at 10 euro strike price. Yes. And basically and use it to earn premium. Since I have closed this trade already, so I'm just using an example or a snapshot just to showcase certain things. So let's assume for the moment this is the call. This is the current scenario, and then you want to buy a 10 euro. Uh, you want to sell a 10 euro call option. So in this case, what you will do is you will select a strike price. In this example, I'm choosing a 920 strike price for an expiration 19th February. So what you do is you basically will sell, use the sell option here from the call, yes, or a write option. And then basically what you do is you will write how many calls you want to sell. And then in this case, if you see here, uh, I'm selling 3 call options. And then I'm selling it at the price of 11 because for this 920, the price is between Geld and Brief, which is like the midpoint is 11. So this is the current price. So at 115, so this is what I'm getting for the 3 call options. And then of course, additionally, I have to pay 75 cents times 3, which is the fee for Degiro. Yes. So after pressing here, basically I will wait for this order to be filled. And if it is filled, it will give me 34.5 minus 225 euros in my account. In case, let's assume I have bought this, I have sold or written these 3 call options, and this is currently in my account. Yes. How to close this contract is I basically buy back this contract. I have an option to buy back this anytime before the expiry date on 19th. Yes. Or in case it is uh, lower than the strike price, if we take the example, if it is lower than the 10, of course this is 790 where, put option, but if it is lower than the 10 as in our example, then at least I will make money, I will keep the premium. If you see here, by pressing here, uh, it will open a ordering status like this. So this is the price what it is being offered here as a limit order. So I'm adding 3 contracts, and then I'm putting okay. I have to pay like 48 euros to buy back this particular order. Yes, which is shown here. Now let's look at a real example. If you see here, this is a call option here, which I have written on 10th of December. Yes. So I have taken premium of 0.16 cents, which is 16 euros per contract. I have sold 3 contracts, and in return I have got 48 euros. Of course, I have paid 2 euros 25 cents as a fee. And as you can see here, on 21st of December, I have bought back these contracts for 0.04 cent, which is 4 euros per contract, which is 12 euros for the 3 contracts. And then I pay additionally 2 euros 25 cents a fee again to Degiro. Let's look into this trade. So as you can see, so this is the stock price during my trade. The wanted position is that the stock price remains less than 10 for my trade. Uh, so if you see here, it has been trading less than 10 throughout. So loss will actually happen if the share price goes up than 10, which is here, this line here up. So if it breaches that line, then I tend to make losses. Of course, the max loss can be unlimited if the suddenly the share price starts going up. Generally, if it is going up a bit, then the max loss is determined by the delta, which is the change in the option price per euro change in the share price. Yes, it's not possible to look at the delta in Degiro, but in other online tools and applications, it is possible to see the delta. In case the share price goes up, then the shares owned by you already in your account are acting as a security. It basically helps you uh, from an unlimited loss and protects you from that. Let's take a look at the trade which I've shown. So as you've seen here, I have entered 3 contracts at 0.16, received credit 48, total cost 225, net credit received 45.75. When I have exited the trade, the debit I paid is 12 euros, trade costs 225, and net debit is 14.25. So the profit I made on this 3 contracts is 31.5 euros. As a rule, I am aiming for 50 to 75% of the premium collected. I try to close the contract as soon as I am reaching these percentage levels. I think important to also know here is the European options are assigned only during expiration or will be called only during the expiration date, not earlier, just different from the US options. Another thing which I want to share, in case you really want to have a real-time data for some of the equities, if you log in directly to Börse Frankfurt, then at least it allows you to add up to 3 securities where you can really watch the real-time prices. In Degiro, you are generally getting a 15-minute delay, but if you log in directly to the exchange, there is option to have at least the real-time prices. I'm using that sometimes, yes, to see when I'm trading those contracts. In case you have liked the video and content, please like and subscribe. Thank you. And in case you want to reach out to me, please reach out to me on the email. Thank you very much.